5 things you need to do before you start investing. Are you doing all 5, or are you setting yourself up for trouble down the road? That's what you want to know, and let's find out. So if you're watching this video, that means you want to make money from investing. My interest and the focus of this channel is on stocks, specifically long-term value investing. But these 5 requirements will apply to any investments that you make. Failure to do any one of these could turn your investment career from a winning game to a losing proposition. So what are they? The number 1 thing you need to do before you start investing is to subscribe to this channel. I'm just kidding. Number 1 thing you must do before you start investing is remember that cash is king. Before you start investing, you need to make sure that you've got enough cash on hand to pay for day-to-day expenses. Most people refer to this as an emergency fund. You can call it whatever you want. Just know that when you invest money, especially in anything as volatile as stocks, that you can't count on it being there when you may need it. Many people learned this lesson the hard way during the financial crisis of 2008-2009, when unemployment skyrocketed and the housing and stock markets tanked. Many people needed more cash on hand because of the recession and were forced to sell investments at the worst possible time. Having a sufficient cash cushion will prevent you from needing to sell investments in times of distress. How much is enough? I would probably recommend at least 3 months of living expenses in cash, with 1 month being the bare minimum before you start investing. Number 2 thing you must do before you start investing is to manage your leverage. If you're just starting out, it's likely that you've got some kind of debt that you need to pay back. Whether it's student loans, credit card debt, or car payments, having debt, especially high interest debt, can turn investing from a probable gain to a likely loss. For example, let's say you've got student loans charging you 7% interest. If you invest any money instead of paying off the loan, you need to get at least 7% to break even at that point. This is because despite getting 7% returns in the market, you have to pay 7% interest on the money on the loan. So effectively, it's a wash. Leverage also makes the losses worse. Let's say that you actually lost 5% in the markets. Your loss isn't then just 5%, it's actually 5% plus the 7% that you had to pay on interest on the loan. So effectively, the loss is magnified to 12%. Investing with high interest debt is really a rigged game against you. So what can you do? Focus on paying down completely any high interest debt you have before you start investing. Anything over 4% should be an immediate priority. For debts over 4%, it's your call whether you want to pay them off or invest. Just be aware of the added risks that comes with investing with debt. The number 3 thing you need to do before you start investing is to understand your ability to take risk. A lot of people actually miss this, and this is extremely important. And it comes down to determining 2 things. 1, your risk capacity, and 2, your risk tolerance. Simply put, your risk capacity is your financial ability to take a loss, while your risk tolerance is your emotional ability to take a loss. The first one comes down to, will you still be able to pay your bills if your investments go down? Well, the second one is, will you be able to stay rational and not panic if your investments go down? When evaluating your risk capacity, 2 of the biggest factors are ones we've already discussed. Having more cash on hand and having less debt allows you to have the financial ability to take on more risk. Other factors like stability of your income and if you've got dependents should also be considered when thinking about your risk capacity. Risk tolerance is more of an emotional gauge. If you, let's say, check your investments every day and you're more upbeat when the market is up, that's actually a sign of having a low risk tolerance. This is because if you feel good when the market's up, you're gonna feel bad when the market is down. And on days like the thumbnail, which is February 5th, just a few months ago, you're likely to panic and might sell at a really bad time. So how do you improve your risk tolerance? Well, part of it goes back to actually improving your financial situation mentioned earlier. Raise cash, pay down debt. Another way to improve risk tolerance is actually number 4 thing you should do before you invest, which is to have a written plan. How much money are you going to have in stocks? How much money are you going to have in bonds? Are you going to spend the time to individually research stocks, or are you going to use mutual funds or ETFs? What's your selling strategy? What's your buying strategy? These are all questions I want you to consider and have a plan for before you start investing. It's easy to jump right in and just get started investing. But if you're like me when I started, you're going to make a lot more mistakes if you don't have a plan in place. Overtrading, not buying and selling on fundamental reasons, and not knowing the specific risks of what I was invested in are just a few of the mistakes I made early on. and these are very common among new investors. Fortunately, having a written plan in place can help you avoid most of those. Number 5 thing to do before you start investing is to avoid trading costs early on. So when you're getting started and you want to purchase a share or multiple shares of a stock, you're going to need a brokerage account. TD Ameritrade, Fidelity, Charles Schwab, Vanguard are all examples of financial institutions that provide this brokerage service. However, they will typically charge you $5 to $10 or so for each trade that you make. So if you're starting with $100 and you buy a stock and then sell that stock and you paid $5 commission on front and end, you've lost 10% of your investment already from that $10 commission. For this reason, if you are interested in investing in individual stocks and securities and are not doing indexed ETF or mutual fund investing, then I recommend using a low or no cost commission brokerage like Robinhood. Robinhood is a mobile brokerage platform that allows you to buy and sell stocks from your phone. Because they don't have physical retail locations, they are able to offer commission-free trades. That means that you're not paying anything when you buy or sell a stock using Robinhood. This removes the frictional cost of trading individual securities and allows you to keep more of your investment. If you're over 18 and interested in opening a Robinhood account, you can use the referral link in the description below. You'll get a free stock and it'll help support the channel. Alright, so let's recap. The 5 things that you need to do before you start investing are: number 1, raise a cash emergency fund. Ideally, this would be at least 3 months or more of living expenses in cash. Number 2, pay off your high interest debt. Aim to pay off in full any debt that has an interest rate over 4%. Number 3, understand your ability to take risks. This means knowing the difference between risk tolerance and risk capacity. Number 4, have a written investment plan. Be detailed and stick to it. And number 5, avoid trading costs early on. Use a commission-free service like Robinhood for individual stocks or use low-cost index funds. So that's it, guys. If you do these 5 things, you're giving yourself a great chance of being a successful investor. I hope you got a lot of value out of this video. If you haven't already, hit the subscribe button and notification bell. My name is Michael. I'll be posting videos here at least 3 times a week on personal finance and value investing to help you build wealth and achieve financial freedom. So until next time, thanks for watching.